Hi everyone, Katie here from On the Block Realty. I hope you're all doing well. And today I just wanted to talk about the recent announcement from the Bank of Canada. They have increased interest rates yet again by an additional 1%, which was a big change for a lot of people. A lot of people weren't expecting that much of a change. So I want to go through what this exactly means to you, run through some examples just to show you what the impact is, and also invite you to ask any questions that you might have about this change. First and foremost, we are a boutique real estate brokerage operating in the GTA. And if you can give us a follow or subscribe to our channel, you'll be updated about other videos that we put out about the market, as well as about our listings and our agents. Right now, we're taking a look at where we are at in terms of interest rate increases. As we can see from this chart over here, we were staying pretty steady through the pandemic for obvious reasons. We didn't want to rock the boat in terms of monetary policy or making any drastic changes that would impact the state of the economy during the pandemic. But now that we're getting through things, we can see that the interest rates began to rise beginning on March 2nd, 2022, where the interest rates increased by 1/4 point. April 13th up to yesterday, which was July 13th, we saw additional increases of 0.5 point up to 1% yesterday. So right now the target rate is sitting at 2.5%. And from what I've heard, the Bank of Canada will likely increase further up to 3%. Obviously, that's not a guarantee, but that's something that I've heard. So we should be prepared for upcoming increases starting in September, perhaps, is the next rate increase. We can see here that this is the rate of inflation, and a lot of people are talking about how interest rates have to go up in order to curb inflation. And we can see here that since 2000, this is the rate of inflation rate increases. And since before 2000, we haven't seen this sort of an inflation rate. In May of 2022, it was reported at 7.7%. We haven't seen this rate of inflation for almost 40 years. So that's quite significant. And it exceeds market expectations of 7.4%. So obviously we need to get inflation in line. And in order to do that, the bank can control that somewhat through the interest rates. So we're going to go through how interest rates work, and my head keeps getting in the way here. So sorry, I'm going to keep moving myself around. But basically, what is the relationship between inflation and interest rates? When inflation needs to be lowered, which is the position we are in now, the Bank of Canada can increase interest rates, which will then curb spending and incentivize people to save more money because they have a higher interest rate for which they can get for their money. So if people don't spend as much, the demand for goods is going to go down. And as a result, inflation will go down because there's no. So inflation basically happens when there's too much money chasing a limited amount of goods. And the way inflation can increase are some things the bank can control and other times the bank cannot control. So supply disruptions, such as the war we're seeing right now in the Ukraine, is something that the government can't control. But when we're talking about an increased demand for goods, for example, that's something that the Bank of Canada can control through the interest rates and through decreasing the demand for goods. Availability of skilled labor is another impact that could lead to higher inflation. And so that's something as well that is more difficult to control, but different government policies could help find more skilled labor in the workforce. So that's basically how inflation and interest rates work. When inflation needs to go down, interest rates need to go up in order to stop spending and encourage saving. The next slide we're looking at right now is the impact to mortgage payments. So this graph right here from CBC News is a great representation of how a 1% point hike will affect your mortgage. And we can see here, for example, with a $750,000 mortgage, you're looking at an additional $24,000 in amount paid over the term of the 5-year term of your loan. So that's kind of the impact that you could be considering. The other thing to keep in mind is a general rule of thumb is that for every 1/4 of a point increase in interest rates, your payment will go up an additional $13 per month for every $100,000 of mortgage. And I know that's probably a confusing statement to many. So let's look at an example. So for example, with an $800,000 mortgage, your payment would increase by about $104 a month for a quarter point increase. But if we are looking at the 1% increase that just happened, you're looking at $416 additional per month on an $800,000 mortgage. It's important, though, to keep a perspective on things that over 50% of new mortgage originations this year have been variable rate mortgages. So the people that are getting impacted by mortgage rate changes are the ones that are holding a variable rate mortgage. However, of all the outstanding variable rate mortgages, about 80% of them have a fixed payment. So most variable rate mortgages, and a lot of people have asked me this in the past, is I have a variable rate mortgages, the rates have gone up. Why haven't my payments gone up? That's because you are on a fixed payment mortgage where it's not your monthly payments that go up. So let's say, for example, the Bank of Canada increases mortgage rates an additional 2%. Then it was very likely that a lot of people's mortgage will be triggered by the trigger rate. And when you hit your trigger rate, your lender will have to increase the fixed payment on your variable rate mortgage to ensure that you're covering the interest that is due. So it says down here, as a very rough rule of thumb, prime rate generally has to rise about 2% or more for you to hit your mortgage's trigger rate. But if you are on a variable rate mortgage now, I would definitely suggest for you to reach out to your lender and just confirm what that trigger rate is, because you want to potentially be prepared for that if it is a lower than expected rate. So just to know financially what you could be expecting. Okay, so not only do higher interest rates impact variable rate mortgages, but it also impacts your affordability. Anybody that wants to get a new loan for a new home has to go through a stress test. And this ensures it just basically protects the lending industry to ensure that people aren't going to necessarily default on their mortgages should the interest rate go up. So let's say if somebody was wanting to qualify and right now the rates were 3.59%, which they aren't, but just as an example, they would qualify for a maximum purchase of $481,000. And obviously that's based on a certain income level. But because the stress test has to come into effect, basically the qualifying rate is 5.25% or your bank rate, which would be 3.59 plus 2%. So in this case, because the bank rate plus the 2% is higher than the 5.25%, then people will need to qualify for this amount. So you can see here that people's purchasing power decreases significantly because of this stress test. And so if we increase interest rates even more, and in this example, if we go up another percentage point, which is what we just saw, this is the impact to your affordability. So it's very difficult for new buyers coming into the market to qualify to get a larger purchase price because of this stress test. And that is definitely impacted when mortgage rates do go up. So let's take a look at an example here of February versus now. As we know, February was pretty much the height of the market throughout the Greater Toronto area. We're going to take a look at an example of a Vaughan home, which in February at the peak, the 4-week rolling average was $1.95 million. That's a lot of money. And so if we were to take a look at a 2.65% variable rate at that time, which is kind of in line with where things were at that time, you're looking at a monthly mortgage payment of $7,105. Now let's look at now. The average purchase price in Vaughan, 4-week rolling average, is now sitting at just around $1.575 million. So that's a substantial decrease to what we saw back in February. However, if we were to consider what people would qualify now in terms of a mortgage rate and what their payments would be, so $6,800 per month versus $7,100 a month. So what's next? I know a lot of you were wondering, what the heck? Like, what does this mean for me? And from my perspective, I think it is a very personal decision as to what's going to happen next, and what you should consider for yourself if you are looking to get into the market, or if you're just have a house that you own and you're wondering, oh my gosh, like what does this mean for you? So number one, it's important to recognize that additional increases are going to be expected. We could probably see interest rates go up another 0.5 point, I would say. That would be my guess. But again, that's just a guess. There might be a slight increase to the sales activity over the next couple of weeks. A lot of buyers right now have a rate hold, and that will allow them to hold a lower rate for a certain period of time, usually between 90 to 120 days. And so maybe there's some people that still want to get into the market at that lower rate. And so as a result, we might see an increase to the level of sales activity over the next little while. It's very important to recognize that buyer psychology and just sentiment in general has a big impact on the real estate market. If buyers at mass feel like it's a very dangerous time to be buying a home, it's going to definitely impact things, maybe even more than the actual interest rate increase. And we saw that back in 2017, 2018, when the government came out with some new rules for the non-resident speculation tax, and how that really impacted things. The impact financially shouldn't have been as much, but buyers saw that and they got scared and they took themselves out of the market at mass. And that's why we saw such an impact at that time. Prices are decreasing, but it's important to recognize that affordability is also impacted. So on one hand, people are saying there's lots of opportunity out there. The prices are going down. You should definitely consider making a move now, but your affordability is being impacted as well. So that's something that you have to keep in mind, as well as the increase to the interest rates and how much interest you're paying on your loan. So you really have to, it's really a big balancing act, and it's important to see the whole picture versus one side of the equation. So depending on your situation, taking a break from the market might be advisable. I think a lot of people are doing right now, just to see how things shake out over the next couple of months. And that is probably an advisable strategy if you don't need to get into the market right now. For others, making a move is a necessity, or it could present an opportunity. And so for those people that are looking to move up to, let's say they're in a condo right now and they want to move up to a freehold 3-4 bedroom home, it's very possible that that could be a good opportunity for you. The condo market right now hasn't been impacted as much as the freehold market. It still has been impacted. It's slowed down for sure. But you might be able to sell at a good price, or, a reasonable price, and get in at a freehold, get in with a freehold product at a much less of a price. So depending on your situation, it could present still a good opportunity for you to move up within the market. And then, of course, it's important to sell first. I think if you're going to buy a home and then sell, you're going to put yourself at a lot of risk, and it's going to be a very stressful process, and you might get desperate a lot earlier than you should and try to sell lower in order to make everything work out. So make sure you're consulting with the right people, financial advisor, a real estate agent, a real mortgage broker, just to figure out what makes the most sense for you, given your financial situation and given your family situation. It all comes into play, and it's important to just make sure you're understanding the full picture, as I said before. So that's pretty much it. I hope that was helpful. If you do have any questions, feel free to reach out to us anytime. We're happy to go through your own particular situation, give you some advice on comparable sales in your neighborhood if you're considering making a move, and we can work together to come up with a solution that makes sense for you. So have a great day, and talk to you soon. Bye.